I was in Costa Rica with my wife, and we got onto horses, bareback onto horses with a guide. It was like the Jack Palance of guides. You know, this guy and everything, you know, get a little cigarette hanging out of the side of his mouth. And we're going up this mountain with these horses. And we end up going around and around on the trail of the horses. And the trail was like that wide. And my wife is screaming on her horse, oh my God, oh my God. I said, do me a favor. She said, what? I said, just hold on to the horse. He wants to fall less than you do. And that's kind of like these companies out there. Hold on to these horses, these companies. They don't want to fail more than you don't want to fail. And the reality is that they will do everything they can, whether it's buybacks, looking to cut expenses, issue dividends, you know, the laundry list of things, the levers that companies can do to make things happen. I think that's something that's extraordinarily important to understand.
Hey there, everyone. Dave Keller here with Market Misbehavior, and welcome to our latest episode of the Market Misbehavior podcast. Today, we're speaking with podcaster and money manager Andrew Horowitz. Andrew is the host of the Disciplined Investor podcast, which he actually started in 2007. Let's talk about being early to the podcasting game, and he is still doing a fantastic job interviewing market practitioners and updating listeners on current market conditions. He's also the president and founder of Horowitz Company, where he manages money for individuals and corporate clients. Andrew is a fantastic podcast host, and so it was a lot of fun to flip the script a bit, to shift roles around and have him on my show where I could ask him questions and really touch on a lot of the themes that he is able to tease out with his guests over the years. We talk in particular about current market conditions, but then we get into process. And one of the great takeaways I hope you find from this discussion is process over prediction. Please enjoy this conversation with Andrew Horowitz. Andrew, welcome to the show. I've heard of you and followed your work, listened to the podcast, and it's a pleasure to speak with you today.
Great. And great going for you. You have an awesome following and a great podcast, and I really appreciate having me on.
I feel like we have a plenty to talk about in a short period of time here. And the Disciplined Investor podcast you were mentioning before we started the show, Andrew, it's tell me again, longest running independent financial podcast.
Yeah, so it's one of the longest running podcasts in finance. Actually, when I say independent, the reason is because what happened originally was there was some of these podcasts out there for like maybe a CNBC or Bloomberg or something like that. They would just rebroadcast what they had. Yeah, I don't include that in the list of like podcasts, right?
Actual podcasts created by a human being.
Right, exactly. Not just spitting out what we did already. We started this back in 2007. I wrote my first book, The Disciplined Investor, and my publisher says to me, hey, Andrew, I got an idea. Why don't we start, marketing the book through a podcast? And I said, what's a podcast? What? I don't understand. What? I literally don't even know what you mean by that. And they told me what it was. And what happened was it fast forwarded very quickly. Actually, Apple in Cupertino, I was flown out there, and they actually showed me how to start producing it with GarageBand back in the day.
Nice.
Yeah, it was a lot of fun back then.
From those humble beginnings, you've had a pretty incredible run, Andrew, which is awesome. So your podcast is called The Disciplined Investor, and our podcast here is called Market Misbehavior. So the moment I was connected with you, I thought there's some overlap here that I want to tease out for sure. I mean, in a world that's dominated by headlines, by social media, by market noise, by all of that, what does real investment discipline look like today, in your opinion?
It's hard because the problem is that all these things you just mentioned they're all trying to get in there, right? They're all trying to force their way into your thinking, into your psyche. And the information that we have now versus maybe, 25, 30 years ago, then it was, you do your research in the library, you read your Barron's, you read your Standard & Poor's on the weekend, you kind of do your best to figure out all the different periodicals that have the information, you open your Morningstar. Today, the information is coming. It's fast and furious. It's like trying to take a sip out of an open fire hydrant, and it is nonstop. The news cycle's 24/7. How do you make decisions? And by the way, how do you know it's real and how do you know it's not real? That's a big issue, especially over the last 10 years. So I think the discipline part of it is all about understanding kind of that noise item and looking where the narratives are and why they're being pushed a certain way and trying to your best to understand what it takes to be successful, to reach financial independence, financial success in a way that, you can play around and you can trade and you can use whatever tools you have for that. But there's a core bedrock of what investing is all about rather than trading, right? That differential, which by the way, both are fine. Do it, I have no problem with either. And in fact, for our clients, we do both. But there's that standard like, okay, you know what? Right now, where we don't know where things are going and all that, we don't need to necessarily pull out of the market. We don't need to be pushing into the market. We could have one foot in, we could have one foot out. But the bottom line is we know that the greatest money-making machine in the world for the last 150 years has been the capital markets and the stock markets, not only domestically, but around the world. So it's understanding the makeup of solid investing parameters, fundamentals, technicals, quantitative, that you can utilize every day to get you back to the ground so that you're not thrown off by a counter blow of some kind of news source that's coming out. And I'll just finish on one point. This all bears out really well right now. Right now, who would have thought that we have a war in Ukraine, we have a war over here, we have these viruses popping up again, we have geopolitics that are absurdly crazy, right? We have oil prices that are up, that the Strait of Hormuz is closed. We have a problem with urea that 40% passes through. We're not getting it. The food prices are out of control. Consumer confidence is an all-time low. Markets are doing great. Who would have thought?
At the end of the day, I was taught the most bullish thing the market can do is go up. And so we seem to have that going for us, despite all those other things, right? You hit on a number of really interesting points, Andrew. One of the things was, there's such a short-termism to most of the news that we consume, most of the social media. It's all the flickering ticks, right? A headline is either really, really amazing or really horrible. It's never kind of neutral. What do you do, and what do you encourage clients to do to maintain a proper long-term perspective in the face of all of this short-term fluctuation and noise, really?
I think one of the things that's really cool to do is take a chart and look at it on a 10-minute basis, scoot out to a 30-minute, then expand to a daily, then do weekly and literally monthly. And if you want to go so far as doing it on an annual basis, and then understand the choppiness of the chart on a 30-minute basis and all the things that can happen, right? With the news flows and all that, the opening bid right at 9:30 when the futures start to pop, but then kind of step back, and literally walk away from your screen, walk away from the news, and look at the depths of the crashes back in 87, 2007, 2020. They're just little blips on a very long-term left to right action. That does not mean, by the way, because I've lived through a lot of this. Listen, you can tell by my age here. I've lived through a lot of this, right? I've lived through early days, just in the 70s, although I was just a mere pup at that point. I was in elementary school, but you knew about it. You knew that there was this year of horrible inflation in the 70s, 80s, and terrible stock markets into the 80s and 90s. Obviously, there's a lot of problems there. And, now we're entering to a state that we've seen in the last, 20 years, two major catastrophic market downturns, even a third. I'll say three. 2022 was pretty bad too. Actually, there was one recently again. We just saw, 10, 12%, but still 25, 30, 40%. And then we had a lost decade of NASDAQ, lost 30 years of the Nikkei. And I think it's a matter of perspective, that understanding that these companies that we're investing in want to do better. And if I could say something, one time I was just brought upon a story. I was in Costa Rica with my wife, and we were on the north part of Costa Rica, and we got onto horses, bareback onto horses with a guide. It was like the Jack Palance of guides. This guy and everything. Get a little cigarette hanging out of the side of his mouth, and we're going up this mountain with these horses. And we end up going around and around on the trail of the horses. And the trail was like that wide. And my wife is screaming on her horse, "Oh my God, oh my God." I said, "Do me a favor." She said, "What?" I said, "Just hold on to the horse. He wants to fall less than you do. So just hold on for a minute." And that's kind of like these companies out there. Hold on to these horses, these companies. They don't want to fail more than you don't want to fail. And the reality is that they will do everything they can, whether it's buybacks, in share repurchases, looking to cut expenses, issue dividends. The laundry list of things that companies, the levers that companies can do, good, solid companies, to make things happen. I think that's something that's extraordinarily important to understand.
No, that's really well said. And to your point, in my background, I have some paper charts on the wall, and they're on the wall as I walk into my office, and then I turn around to sit down at my desk, and I have them there thoughtfully and intentionally so that I remember the long-term history and respect the fact that the market has literally recovered from 100% of corrections going back to the beginning. I mean, it's always come back to new highs. Sometimes it's taken a lot longer, but it's gotten there. And remembering that, particularly in periods of market instability, to your point, I think is really, really well put. And I want to talk about the current market environment for sure, and then talk a little bit about process and how we can help our listeners and our viewers, just try to make sense and navigate through the noise here. But sticking with your comments about earnings, right? I think we often, at least a lot of the stuff that I read, focuses a lot on the negative, features of certain founders and, management that is not maybe 100% as ethical as you might want. But we have to remember that in a lot of ways, our goals are in line. They want their companies to do well. They want the stock probably to go up just as much as you do if you're holding it.
Yeah.
Having said that, the earnings generally have been remarkably strong, particularly given the uncertainty, all the things that you mentioned earlier. In a lot of ways, it feels surprising that the earnings are so strong. How are you reconciling, we coming out of an earnings season that I would have to say you have to summarize as fairly positive versus the macro environment that seems so uncertain as ever? How do you reconcile that in your own process here?
So I think that the big thing right now, and actually we talked about this over the last few episodes, is there is an extraordinary amount of money that is still coming from the CHIPS Act. Last week we saw, I don't even know, $1 billion pour into quantum companies based on the 2022 Biden CHIPS Act. That was being used, and there's still money flowing into companies. Pretty amazing. We know that government is picking winners and losers. Just this week, we saw that there's money now going to drone manufacturers, and the government is taking a piece of that. So you have this invisible hand, something we never had before, or at least it wasn't as open and apparent, where the U.S. government's taking a piece of Intel, for example, right? The other thing is we had the One Big Beautiful Bill Act, huge. What everybody says is it's not. It's a huge stimulus package. We had the IRA, right? The Inflation Reduction Act, which wasn't really an Inflation Reduction Act. There's still money coming from that. Then we have something that's really fascinating right now. Now, remember something. In a market cap weighted environment that we have now, where the biggest companies are the biggest providers of the overall composition of a market, thereby also the overall composition of the earnings in the markets, they're all feeding each other. Now, some of this is what I call circular financing. It's vendor financing. But what they did was something fascinating about 2 years ago. They started doing something they never did before. Well, I wouldn't say never, but really not as overtly. They started taking money off of their balance sheet, all this money that was sitting on the balance sheets for years. And they were talking about, well, we'll buy Bitcoin, or we'll do something with it. But all this money that they were created from the Microsofts and the Googles of the world, and they started utilizing that. They started utilizing that in a circular fashion. They started giving that to NVIDIA. They said NVIDIA. They said it to all these other cloud plays. We're going to give you this money, but we want you to then utilize our cloud as an example. NVIDIA gave money and said, hey, we're going to give you money, but you're going to have to buy our chips. So they took this huge amount of money off of their balance sheet and routed it through their cash flow statement. That's what happened and why earnings is so amazing, because these major companies that are out there started doing it. Now, the Campbell Soup didn't do that. Take a look at their stock. Other companies that didn't have that kind of thing or the need to do so, like a Salesforce, or maybe the SaaS companies, or maybe any of the other tech companies that really didn't have that need, didn't do that. But you look at the hardware, software, AI, cloud-based, anything that was involved in this whole AI trade, lots of money have gone from a balance sheet into or a promise of, right? That's how Oracle. Yeah. So that's one thing that's done well. The second thing it's fascinating, is the consumer. They always say, don't count the U.S. consumer out, ever, ever. Consumer confidence based on the University of Michigan numbers, worst ever. When I say that, I'm not exaggerating. The worst ever. Just out last week, I think it hit a 44 in its 74-year existence. Never been a worse consumer confidence number. You would say, that's pretty terrible. I looked into this because that's something I followed for years. We follow a lot of the economic models. And one of them being the University of Michigan as a highly important data set. Well, then I started realizing something's not right. When I look at the other data sets from the conference board, for example, their numbers, not as bad, not great, but not as bad at all. Nothing like this. The problem is the makeup of the questions and the likelihood of what they're focusing on in the different reports. Consumer confidence from University of Michigan, very inflation heavy. Okay, well, that makes sense. I see my gas price going up. I was in California, not too far from you, at least on the West Coast.
Yeah.
And diesel was $8 a gallon. The guy I was with had a 60-gallon F300. And I'm like, how much are you paying for fuel to fill this thing up? It's unbelievable. And so if you're part of that group that's answering the questions, you're pretty miserable about inflation related. And therefore you have to look at this and say, well, it's not that, but the proof is in the pudding. Retail is still spending. There'll be a point, by the way, when I go to the store and I saw $9 cauliflower, I said, you know what? Here's my moment. No, there's my limit. I didn't pay $8 either, but it was $9. I said, I'm not paying for it.
Yeah.
Tomatoes have gone from $20 a case to $80. Restaurants are going to start changing what they're doing. And, but it hasn't happened so far. There's a lot of money that's being flushed into the system through the One Big Beautiful Bill Act, the OBA, from the change in the withholding. People got back a huge amount of money in their tax returns. That will end. The amount of money that's in checking accounts is dramatically higher than you would think. It's been growing for years. And that's because of the withholding numbers and all the things that are going on. Tax receipts supposedly up. Bottom line to all this is a full circle on all this is that all that is feeding into this, even though gas prices are high. There's a war over here. Oh my God, this is happening here. I can't believe they're doing this. The fact is that companies are doing great. The AI generation is creating productivity gains. They're laying off people, even though they say they're not doing so. They're laying off people for AI. And consumers are still kind of okay with everything. So it rounds out.
That's such a great summary, Andrew, about a number of different factors. And I'm glad you touched on the consumer, because I feel like on the surface, if you didn't know what was going on with the markets and you heard the latest reading from like the U of M, consumer sentiment, you'd think the market was probably in very poor shape, right? Or starting to show real signs of weakness. And we're seeing kind of the opposite. So one thing you did not mention there in that discussion was valuations. And so a lot of people are questioning, yeah, all of that is fine. The companies seem to be doing well, but now we're paying more and more. Something like NVIDIA, right? A great example of where valuations are at fairly extreme levels, regardless of how you calculate it. Did valuation, given everything you said, given the money being injected into the system, does that mean valuations don't matter at this particular point in the cycle? Or how does that influence how you would be taking new positions here today, given the run that a lot of these names have already had?
So the answer to your question first is very straightforward. And yes, valuations don't matter. Not by me, I'm out of that group, but valuations don't matter. And you have to respect that. Mm-hmm. You don't want to fight a tape that just goes up no matter what happens. Hey, we dropped 3 more bombs and they call it a ceasefire. We're still in the ceasefire, by the way. We keep bomb, but we're still ceasefire. This kind of ridiculousness, the alternative facts world we live in.
Yeah.
And I know you're a CMT, right? So you pay a lot of attention to the charts, and you cannot. I would defy you to tell me one indice that you would be like, no, that's a short right now. Now you may see it from a short. Tell me if I'm not. I don't want to put words in your mouth, but you may see it as short from an extension, like there are clear, like an MU. Well, that was a weird extension right there, and it is a bullish extension, but yet it's also kind of an exhaustion gap that we saw the last few days. And that's something that you now. Do you want to put your money on that though? Do you want to put your money on the short side? I don't know. The fact is it's very difficult. Something is going on underneath all of this. When you look at, I don't care what you look at. You want to look at straight, just simple charting, or you want to look at some of the things like, RSI or MACD or various channels. You want to look at stochastic. Everything looks wacko, right? Let's just get that straight. But the fact of the matter is it keeps on getting more wacko. And you can't go against that. We know, everybody knows that this is not going to last. And valuations, valuations are artificially pumped up to a degree, but that doesn't mean they can't be artificially pumped up more. That doesn't mean that Meta may not lay off another 20,000 people and save a lot of money. That doesn't mean that, what did we see? There was another one, there was a $9 billion injection into today. There was a Snowflake.
That's right.
Did like a $9 billion injection into Microsoft, right? And or Amazon. Was it Amazon or Microsoft or both? No, Amazon had another injection into Microsoft. So, and Dell, that's what it was. It was Dell. It was a huge thing for Dell. Dell's up another 6.5%. Dell's at $300 and something a share.
Yeah.
I mean, didn't I walk into the office yesterday? It was 45. It's crazy. These are like numbers like years ago. I'd always be looking at the Nikkei going, wait, those shares are like 1,200 yen. I'm like, well, thank God we're only like at $8 a share for this or that. It's too complicated. But the days of stock splits are over. Valuation, until they're not. Valuation is a concern, depending on how you look at it.
Yeah.
Valuation's a concern in the market cap weighted indices, in that if they don't keep on funding themselves through the circular financing, vendor financing, and balance sheet financing of income, and if someday all of a sudden AI is not producing, but it seems to be doing so, that's going to be a big issue.
Mm-hmm.
I am not caught up in valuations right now because, as you know, as an expert and a master chartist, sometimes you can't. If everything's telling you that the world is falling down, but the stock charts are going up, you don't fight that, do you?
I was taught two things, Andrew, and to all of our listeners, I did not ask you ahead of time to promote charting so much. So thanks for doing that independently on your own. Much appreciated. But no, I was taught, don't fight the Fed and don't fight the tape. Those were your two infallible rules as an investor. And don't fight the tape is probably the most important of the two. And so,
even though you want to, right? I mean, come on, don't you? Let's be honest. Let's talk amongst ourselves for a second. Aren't there times you're like, man, I gotta take the short. I don't care what this is looking. And then what happens though? You get busted out.
Usually, right? And playing the short side, I've always told people can be an incredibly profitable if used in a short-term basis, right? It's a profitable short-term approach, but long-term shorting of the markets has literally never worked out. I mean, it works in a short period of time. It can be immensely profitable, but being a long-term bear generally has not paid out.
Do you know why, by the way? Do you know how we know this?
What is that?
Look at the guys that were the big short guys back in the day. Where are they now? They go from $4 billion of assets to under 100 million. Literally, like Paulson. He was like the king. He's like, oh, look at this guy. Barry. How about Barry? He shut his stuff down.
Yeah.
I mean, these just can't work. And even if you think valuations, you cannot, well, first of all, you can't market time on valuations. We know that, right?
Yeah.
Yes. Long-term, if you're willing to take a longer term approach, I can tell you probably 30 stocks that are way overvalued that will be coming down and will get hurt. And by the way, a lot of those are the semiconductor stocks. There is a cycle. If you're doing this long enough, put it on a chart, just look at it. Semiconductors cycle.
Yeah.
Now, is the cycle dead? No. Is this time different? No. It's just a little bit bigger and broader, and everybody wants them now. And it may be because we need them a lot more for a much bigger situation, but it's going to cycle. Just like energy. Nobody wants to be in energy. Then look what happens. Nobody wants to be in gold. Then silver. Silver. 20 years. Look how great that was. Look what's going on with South Korea. That's an unbelievable thing. And now that's a problem, by the way. Two stocks make up 40% of their index. That's a problem. That's what happened with Petrobras back in Brazil. Why would invest in that as a core investment? Trading, sure. 40%, two companies, Samsung, SK Hynix, are the components of their stock market, the Korean stock market. EWI is a symbol. Great to trade. As a matter of fact, on DH Unplugged, I picked that as a pick. We do stock picks on that show. I picked it right in March. I said, look, if the Strait of Hormuz opens, if oil prices come down, and interest rates kind of chill out a little bit, Korea is going to be off to the races again. I was so right for the wrong reasons. So right for the wrong reasons. It's up 50% since I mentioned that. It's up 178% last year. It's up like 92% this year. The market. It's unbelievable.
Yeah. No, there's been some pretty incredible runs in so many different areas of the market. So to summarize just this discussion about the current market environment, and I get the benefit of being able to listen to a lot of your recent episodes and just reflecting on what you've asked people. So I get to ask you similar versions of those questions, see how
Right.
you would answer that,
Okay.
and flip the script a bit. You mentioned on a recent episode, and the quote was, "There's going to be a cliff coming," right? There will be a cliff, right? And to your point, as a trend follower, I have to reconcile the fact that the trends remain remarkably strong here in May of 2026, right? Market's making new highs. So regardless of what you think should happen, the trend is still positive until proven otherwise. I think of the market as innocent until proven guilty, but I feel like we're seeing the evidence start to gather. Like you can see hints of what that thing might be. As you are having a lot of conversations and reviewing the evidence on your own, do you have a sense of what you think that cliff is going to be? What's that thing? Is it interest rates? Is it the Fed? Is it geopolitical issues? Is it a combination? Like, what's that thing that we need to be watching out for the most?
So two things. First of all, I heard a little channeling Brian Shannon there.
Yeah.
My good friend, very good friend of mine for many, many years, by the way.
Yeah.
He's been on the show. I got to get him back on the show. But yeah, he was always innocent until proven guilty. Interesting.
Yep.
The second thing is, I don't want to sound like all these other talking heads, and they're like, well, there is a cliff and we know this is going to happen, but we're not going to bet on it. The whole line that they give you. Here's the deal. It's going to be something different. I agree with that. We're not exactly sure what it is. Right now, markets don't really care if we're in a war or if, I don't even know what, if who knows if the Democrats take the House in the midterms, that could be something. That definitely could be something.
Yeah.
But I think because they're going to just try to impeach, and that's going to be their bailiwick on that. I think the one thing that could throw this thing, because if we have a consumer that is questionable, that whole range of things, if we have stimulus that will probably be ending, there's still a lot in there. The secondary or third tier stimulus, which is corporate monies into the system from the balance sheet, that dries up. If we see any question again, because we had a little scare with the CFO from OpenAI, from ChatGPT, said, hey, you know what? We're not meeting our growth numbers on revenue or on earnings. That's or growth of signups and all that. Everybody freaked out because they got like $1 trillion that they're saying they're going to pay to all these companies. $1 trillion they don't have, by the way. And is it going to be the SpaceX? Maybe it could be SpaceX IPO sucking the guts out of everything in the market, because that's set up to absolutely win with the parameters that we've never seen before. For example, they're going to be allowing for the lockup periods to change versus the normal. They're going to be including that in the index within like 5 or 6 days, which means all the indices, all the ETFs, all the mutual funds, all the managers that are index based that follow that, and this is going to be a big company, are going to have to put huge amounts of money where they get it from. They're going to have to suck it out of other places, right?
Yeah.
That may be temporary. That we're going to see the SpaceX go up and then it will settle down, but who knows what comes along with that. So I don't know what it is. I'm not going to proclaim to be, this guru that could tell you that, on October 22nd, there's going to be this whole thing, or one of these stupid asses on TV, with their prediction100.com thing, that there's something coming and only I know about it. Ugh, come on. Not happening.
All right. So it was October 22nd, you said, Andrew. Got it. I'll write that. I'm joking. No, listen.
That'd be great, huh? If it happens.
Well, now it's on record. So, I'll definitely be watching on that particular date. But no, to your point, I think, and what I love about what you just described, I think we tend to idolize this idea, right? This mythical prognosticator who is able to predict things ahead of time. And I always try to tell people, if you're having challenges as an investor, you don't need like a shinier crystal ball. Like that's not what you want to be doing. You just want to be focusing on gathering evidence and recognizing when conditions change. I think prediction is overvalued and process is undervalued. And that idea is something that I certainly picked up on hearing your discussions and reading some of your work. So I'd love to ask you, Andrew, just to start to finish up here. What does process look like for you, and particularly working with investors and trying to encourage better habits and better decision making? What are some of the things that you think people get wrong on the process side? What could they do to improve that?
I think they get swept away, first of all, with narratives, as we started the discussion with today. They get into this whole thing of watching. First of all, I don't mean to diss CNBC, but man, that has gone down in product. That product has gone down the tubes over the years. Morning show is almost unwatchable. It's turned into a political discussions that are just dumb. And, it becomes almost and when it's happened several times, it seems like everybody's just shilling their goods and talking their book. That's what they got them on for. The process is about, it's first of all, it's long-term for the most part. It needs to be with a view of the future that is not of today or tomorrow. The process that we have is very distinct. It is very repeatable. It is very, it is very much a solid way of looking at things, which can be changed. Our equity strategies, where it's like a long short strategy we have, it's an absolute, here's the stocks you're going to buy. And a lot of times we go through this quantitative and fundamental screening process and utilize some technical overlays. And I'm like, oh no, that stock's in the portfolio this quarter. I would never buy it. I'm not buying the stock. I'm not doing, I can't. And it's like, well, that's not your choice. I built this, right? So not your choice. And then what ends up happening? The punchline to this goes up, it goes great. It's like,
Yep.
you know what? I should listen to what I do. The same thing. It's the same exact discussion with technicals. I mean, everything could change at any given time, but the fact of the matter is when you look at, your trend issues, you have to be respectful of that. The idea, what you need to get out of your head is this time is different. You need to get out of your head that you're smarter than the markets. Probably I should have started with that. You're not, we're not. Dave, all due respect to you, both of us together, we're not smarter than the markets, are we? No.
I don't think so. And the sooner we admit that, I think probably we're on the road to recovery, right? Step
Right.
one of the 12-step process is
Exactly.
admit you have a problem. So let's start there.
The other thing is we use a lot of mutual funds and ETFs. We have some core, I like to do core investing and wrap around with some other things like our other strategies. So the core investing we do for clients is this long-term, relatively boring, but yet very profitable long-term process, right? And it's kind of like, I don't have to be the fanciest. I don't have to be the guy that's like saying, hey, I found a stock that nobody knows about. Listen, it's worth 4 cents right now per share, but I'm telling you, it's going up. It's going up because this and that. I know they're losing $42 billion a month. I get it, but that's not going to last forever and blah, blah, blah. That's not the kind of thing, right? It's not looking to be the guy. And sometimes it's good for business to be the guy that's coming up with crazy ideas. And we do that, by the way, on the games for DH Unplugged, just for the fun of it. We come up with stock picks every week. And, it's always some insider trading thing or some other thing where it's, for example, United Healthcare is like, okay, this thing is done and gone. We're going to buy it. We're going to catch the fallen knife. We're going to buy it. It's a 40% target. Never looked so bad in the world buying it. It was when the low of the Korean market. I said, you know what? We're going to buy that right now. And those things have played out because the overriding trend has been positive, right? And that's, I don't know, 80% of the reason why stocks go up is the overall trend of not only the sector, the index, et cetera. So I think the one thing you do is admit that you're not the smartest guy in the world, that you don't have an edge really. And what you need to do is diversify appropriately. Don't overweight content. You can concentrate, but be careful about concentrating in an idea. Don't keep on buying something just because it's going down, and don't be spooked out of something at the wrong time. I could tell you a story if you want to know about Carvana. I'm like, this stock is going down. I don't like it. I read about the fundamentals. There's a fundamental problem. But I see a bunch of short sellers wrote some interesting pieces on this. I looked at it. I shorted the stock. I was immediately off like 30 points. Okay. And I said, man, this is terrible. Where's it going? It kept going up, going up. I said, I can't take this. And what I did was I said, it hit my number, right? I said, you know what I'm doing? I'm going in hard on the puts. I went in hard on the puts, made more money back on that, by the way. Let it rest. I made all my money back plus. Let it rest a little while, let it come back up, shorted it again, then wrote it down dramatically. Now they're trying to do like a 10-for-1, or I think it was a 5-for-1 reverse split, I guess it was. They're trying to do, or they did, you could see all the markings are on the wall that something's not right.
Yeah.
And I maintain a short position personally on that stock, but we will use that as an example of, sometimes you also got to not believe you're the smartest in the room, but you got to stick to your britches. You got to stick to your beliefs. And if you have a real idea about something going up or down, something, whatever it is, just hold on to that belief long-term and try not to get swayed. And don't take golf club tips. You're on the putting green and guys like, oh man, I made so much money on this stock. And you get, week after week, he's telling you stuff. Ask one question before you buy that stock. Tell me about some of your losses. They never come up on the golf course, do they? I've never heard of a stock loss on a golf course ever.
Never happens. Never rains. No losses.
Right.
It's a perfect place. It's an oasis. Andrew, this has been an absolute blast to chat with you. And my one final question would be: you've interviewed probably hundreds, if not thousands, of people over the years, hosting the Disciplined Investor podcast, which is awesome. And congrats again on that incredible run. I think your work is excellent, and I appreciate what you're doing. What's your biggest lesson learned, having had a lot of conversations with a lot of smart people through a number of really interesting cycles in the market?
I think that sometimes if you listen to what is being said and from very smart people, and there's always something to be learned from every conversation. I know that seems kind of basic, but listen. More people want to talk more than they want to listen. I'm a talker, by the way, as you know, as you can see. But more people want to. But there's a difference. I talk, but I also listen, right? I'm absorbing. Listen to what's being said. Take the lesson. You can always throw it out, by the way, but at least listen to it. If you have a great guy on that's talking like the authors that have written books on other master investors, listen to them. Somebody who specializes in charts, in futures, they're in their trenches. They do this all the time. Somebody who is an expert on tax law, whatever it is, listen, you'll find a nugget in there. And I think that's the best thing I could tell you is that there are so many wonderful people out there with great ideas. Stay away from the braggarts. Stay away from the guys that are pushing their own books, the sincere people that are really trying to help people in the world, or they can impart knowledge. Not everybody will. A lot of people keep it close to the vest. Dig, find that information. And by the way, share also. That's what I can say.
Andrew, that's awesome. That's awesome life wisdom for interpersonal communications, not just interviews. I'm all ever hopeful we listen more than we talk in a lot of ways. So hopefully that helps us get to a better place as a society. Listen, I hope all of our viewers and listeners listened today, because I thought you had a lot of thoughtful investment wisdom to share. Congrats on your ongoing success. We wish you much greater success. For now, I will say thanks for coming on the show today.
Thanks so much. Thanks for having me. Appreciate it. Appreciate you.
Oh, it was a lot of fun. And thanks again to Andrew Horowitz coming on the show today. It was a real pleasure having listened to a lot of Andrew's podcasts and checking out his work. I was really excited to talk markets and talk process and talk ideas with him, and he did not disappoint. Great takeaways, great insights, some great sort of timeless quotable things in there. And I love that idea of process over prediction. I think, for me, what we kept coming back to was, thinking more long-term, thinking about, the process of evaluating conditions and how that's so important to overcome behavioral biases and really inject discipline into your process. Just a couple quick observations after reflecting on my conversation with Andrew Horowitz. First, I ask any guest that comes on the show just some version of what do you think about the current markets and balancing, all the conditions that we're seeing, macro conditions that seem at some points very, very dire. And how do you reconcile that with companies that still are spending a ton of money, but also earning a ton of money, particularly in the technology space? And I thought his comments really focusing on liquidity were a really, sort of thoughtful, and I think a fair way of thinking about what could be causing these equity markets to look so robust. I think as the markets are going higher, people are explaining that in the form of, look, companies are making a ton of money. AI is a moneymaker. Look at how much these AI related names are look at how big their revenues are, but also look at how big their bottom line earnings are. Like, they're making money on these products. He talked about that circular financing, and he talked about the liquidity that is being involved. Those are two things. And then buybacks. Those are like three things that I would argue can artificially kind of make the market look a lot better than it really is. So before we get too excited about the incredibly robust revenues and earning streams and the incredibly bullish expectations, let's remember there are a lot of other reasons that are causing the markets to go higher. And liquidity is often a really important one. Anytime the market is moving higher when it feels like it maybe shouldn't be, it's usually a liquidity-driven bull market. And my conversation with Andrew definitely, I was writing down, to think about that and tease that out with other guests as well. The second thing I actually jotted down as he was talking about some of the mistakes that investors make, I wrote down on a piece of paper, narratives equal noise. And I think that's a great way to think about it, right? He talked about people getting trapped into the narrative, right? And that's a common mistake I've seen investors make as well. They kind of create this whole narrative, right? This is what's happening to rates. This is what's going to happen to the Fed. This is what gold does. This is why inflation's the thing. This is what should work and this is what shouldn't. And then when market conditions change and the tides shift and the winds reverse and all of a sudden things look very different, they're still so dialed into that narrative that they're unable to recognize that narrative is no longer valid. That's actually a well-documented behavioral bias called the narrative bias, where it gets so connected to a narrative that you're unable, it's like you have blinders on and you're unable to see that things are different and that narrative is no longer serving you. And I think the way that he talked about getting through that gets to my third point, which is, he offered up a number of times, and I promise I did not ask him to go there before we started talking. He talked a lot about charts and talked about trends and talked about momentum. And as much as we can think about conditions on the macro side, think about earnings trends, think about valuations and expectations, at the end of the day, is the market going up or down? And I spend a lot of time every day analyzing market conditions, looking at charts and thinking about them. The first chart I look at every single day is a weekly chart of the S&P 500. The second chart I look at every morning is a daily chart of the S&P 500. And I do those two things first before I do anything else, just to remember the trend, to focus on the trend. So regardless of what I think could happen or should happen, it is undeniably an uptrend when I'm looking at the charts here and, at the end of May of 2026. At some point, it won't be an uptrend. At some point, we'll start to see some shifts, and we'll see it probably not just on the chart of the S&P or the NASDAQ. We'll see it in breadth indicators or in volatility or in credit spreads or, different indicators that we can cite. But, the way that we stay on top of that is by consistently evaluating the chart. So I really appreciate that in a larger discussion about potential opportunities and potential risks, he made, I think, a very thoughtful point about the importance of just focusing on the trends, not fighting the tape, and recognizing that charts are still relevant here in 2026. Great take there from a great market practitioner and a very capable host as well. We'll include links to Andrew's podcast, The Disciplined Investor. He also mentioned DH Unplugged, which you mentioned was sort of like we talk about other stuff, but then he mentioned he looks at stocks there as well. So I'm sure you'll probably enjoy both of them. We'll make sure we include links to those podcasts, and I'd encourage you to check out Andrew and his work. He does a fantastic job. Thanks again, Andrew, for coming on the show today. By the way, if you want to learn more about that, what we were just talking about, trend and how to analyze trends, how to develop good routines to assess how the trends may be changing in the stocks and ETFs and markets that you're focused on, our Market Misbehavior premium members were designed, or premium memberships were designed to help you upgrade your own investment process. 3 great benefits to the premium membership. First off, we'll teach you all about technical analysis and behavioral finance through our virtual courses. They are on demand and at your own pace. Second, you will have access to our member reports, like our weekly flight plan, which we put out every weekend, and our monthly chart review. And we'll get our June chart review out at the beginning of next week. That's where we take a big step back, look at a lot of weekly and even some monthly charts, applying our proprietary market trend model to a series of ETFs and asset classes. Finally, you'll have full and immediate access to our member community, where you can ask questions, where you can learn from other like-minded investors, and have me and others mentoring you along the way, keeping you accountable, keeping you well-fed with ideas and insights. All of that is available to our premium members. You can find out more information today at marketmisbehavior.com/premium. That'll do it for today's episode. Thank you so much for watching and listening here on the Market Misbehavior podcast. My name is Dave Keller, here to remind you it is always a good time to own good charts. Take care, folks.